warm welcome. I'm Philip Alexander, the Senior Editor of the Banker magazine, coming from the IMF and World Bank annual meetings 2014. I'm here with Anne Richards, the Global Chief Investment Officer of Aberdeen Asset Management, to talk a little bit about the prospects for the markets over the coming year. And we've seen at these meetings a number of emerging market central bank governors, most notably the Indian central bank governor, talk about the need for the US to coordinate monetary policy a bit, the potential impact that it could have on emerging markets as US rates begin to normalize. Is that something that's a concern for investors, or do you think emerging markets can be resilient to it?
Clearly there's some anxiety that emerging markets might be caught on the tail of any move that the Fed makes. But I think the lesson from the taper tantrum last summer was that in fact those countries which are on the right track in terms of their fiscal and monetary policy within their own environment will recover quite quickly from any short-term turbulence that might be resulting from that Fed policy. So I think it is a genuine concern for particularly some of the larger markets in the emerging market world that they might be the victims of the Fed policy, but actually the underlying demand and growth characteristics of the individual countries will ultimately be the factor that determines how they perform. So I think that the key message is to look through any short-term volatility that comes from that and to focus on the fundamentals. And the other aspect we've seen this year, obviously, if US rates are normalizing because of a growing economy, that's a positive thing. But there's been a build-up of geopolitical risks this year in the Middle East, obviously the Ukraine-Russia situation, and more recently we've seen the World Bank expressing concern about what the impact of the Ebola epidemic in West Africa may be on regional and global trade. Do these kind of risks have a cumulative impact on markets, or is this something again where markets are able to detach from that and continue growing? I think you have unquestionably seen a coming together of concerns from a number of different areas, and I suspect that some of the things that you've mentioned around the geopolitics, around the potential impact of Ebola, if for example international travel starts to be curtailed, international trade starts to be curtailed, I think there are some legitimate concerns around those factors that the markets have to fight their way through, and I don't think those are going to be resolved in the very short term. But markets are quite good about internalizing and pricing those risks, so it may take us a few days, a few weeks to work out the scope of them, but then they will move on from that, I think. But unquestionably the geopolitical tension around the world has risen, and perhaps the slight conundrum in all of this is why the oil price has in fact sold off against a backdrop of increasing tension in the Middle East.
And I mean, just finally, obviously the less positive aspect is what's been happening in Europe, signs of growth slowing again from already relatively low base. The European Central Bank has started to act and take some further special measures to try and deal with this. Do you think that those can have an impact? Do you think that Europe can turn around? What's your expectation there?
Of course Europe can turn around, but I think the key lesson that we've had over the last few months is that it's been too easy for European politicians to look to the central bank to use monetary policy as the way to cure all ills. And if you compare and contrast the US experience with the European experience, the reason that the US has recovered much more quickly has been because it's not just focused on monetary policy. The transmission mechanisms of loose monetary policy into the real economy have worked. So you've seen business lending pick up, you've seen genuine job creation, and it's those things which are missing in Europe. You are not seeing the transmission mechanisms work through the financial system of loose monetary policy into the real economy. And until that happens, you will not get a meaningful pickup in Europe. And I think the lesson that the ECB is trying to teach European politicians is, I can't do everything by myself. I need you to follow through with fiscal and regulatory reform so that when I give you loose monetary policy, if I give you QE, you've got the measures in place that can allow this to affect the real economy. And I think that is the key challenge and the key message for European politicians that have come out of this week.
And if, as intended, the comprehensive assessment that we now know being published on the 26th of October, if that does improve confidence in the state of the European banking system, is that something that can also help improve that transmission mechanism and get credit back into the economy?
I think it will help a little bit, but I think the types of structural reform which are needed in Europe are much more far-reaching than simply saying, actually, the health of our banks is a bit better than we thought it was. It comes down to freeing up labour markets. It comes down to taking away some of the regulatory blockages so that, for example, it is easier to create a new business. It is easier to get lending for a new business. Those things are quite difficult to do in some of the core parts of Europe. And in a way, core Europe, the big economies like France and Italy, need to look at the level of reforms which have had to take place in countries like Ireland, Greece and Spain, and learn from those lessons about what really is needed, the tough medicine that is needed in order to rebase the economy and start growth going in the right direction again.
Anne Richards, thank you very much.
Thank you.